Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management. Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. All right, Yield Nerds, welcome back. Episode 114. I hope all of you had a wonderful spring break. I certainly did. I thought I would kind of pick it up at the end of Q1 and talk about sensible investing ideas in an exuberant market. And that is me walking on roads paved with dollar bills on Wall Street. And there are jewels hanging in trees. I should probably grab a couple of them. We are up to 280 subscribers. Thank you for your support. And if you are new, please consider looking at the playlist, which organizes the show from a beginner level and all the way up to here. And most importantly, I do not have any magical powers, so make sure that you check yourself and validate what you're seeing. Getting back to walking with bags of money, it just seems to me that after Q1 2024, avoiding risk is for losers because everything is going our way. How awesome. Let me explain what I mean. The last 6 months have been at 3% or so. I mean, I'm pretty happy with that. I'm not a very risk-taking person. This year to date, I'm kind of sort of, edging up on 1%. Maybe I add another quarter percent for taxes, living expenses that I took out of the account. There goes taxes. I paid my taxes very early. There goes some living expenses and construction expenses. So all that aside, you take all of that out. I'm still at the run rate of about 6% return for a year, which I'm very happy. Note that most of my returns are state tax free, so it kind of goes up from that, which is good. But as I look on the side, I see that the S&P is up 11% almost year to date, and for the last 6 months, the S&P is up 22%. Holy smokes, what am I doing? This is the exuberant market. I am clearly not reading the news. As a matter of fact, when I start paying attention to the news, I see that inflation is done. No more inflation. The PCE inflation, which is what the Fed watches, is down, down, down. Even the core inflation, metrics are down. Just don't mind the fact that they've kind of come down quite a bit and they're sticky. I don't want to use the word sticky. It's apparently a bad word, but it's not edging towards the 2%, but it's more in the 3% area. And at the same time, we all have something to celebrate. It's no longer 6%. So that's giving the market and the Fed, frankly, a lot of cheer. And you start looking at the notes. This is an investor business daily article. And the Fed says, hey, it's possible we can have a rate cut in June. And the exact words used by Chairman Powell, very, very interesting choice of words. We want to keep the strength in the economy but allow for further progress on inflation. What does that mean to you? You do your own math. I read that as a possible June rate cut, which, in one sense could mean that an even higher equity market in June. That's at least how I read it. And so everybody agrees there could be 2 or 3 rate cuts the rest of the year. That's not a debate. The question is, when is the first rate cut? And the reason I would care is if I want to extend duration, I have to plan accordingly. Having said that, is everybody in agreement? Turns out 5 voting members of the committee say we need 2 or even fewer than 2. Chairman Powell, let's leave the jeweled trees in place. Let's not take the jewels out. Let's let the economy grow. We don't want to pour more gasoline on the fire, so to speak. And Chairman Powell says, hey, it's okay to have dissent. And, I'm still going to keep the strength and allow it to grow further. And so my sense is Chairman Powell is going to drive for consensus towards a potential rate cut rather soon. And so you have to sit here and say, if that is how Chairman Powell is issuing his edict, what are the big kids doing? The big kids with giant piles of money. And I started doing a little bit of research, and before I share that, I want to make sure I let you know I am not a wealth management advisor. This is not tax advice. I don't do politics or product. I am sharing my lessons. So here you go. Commercial banks buy treasuries at the fastest pace since the pandemic. Makes sense. And let me show you a graph to put this all in perspective. Check that out. As the treasury started increasing rates from 0.25%, banks started rolling more and more into the higher paying treasuries. But here is the interesting part. Just the last couple of weeks, the pace of adding treasuries has just skyrocketed. And you have to sit there and say, gee, I wonder why the people with a ton of money are doing that. They probably are reading Chairman Powell's message the same way I'm reading it, which is that rate cuts are imminent. You might as well lock in the yield. Let me see what the article says. This is Bloomberg. And so Bloomberg specifically says, hey, it's most likely that the commercial banks are buying low duration treasuries. Having said that, they are going to buy additional treasuries because of something else that is happening, which is the quantitative tightening program. What is quantitative tightening? It is mopping up extra money in the market so it doesn't drive inflation. At the same time, when inflation is coming down, you want to put more money back into the market to keep growth. And that's the mixed message that Chairman Powell was saying, which is we're going to keep the strength and allow for growth. And so it's possible some folks with a whole lot more zeros in their bank account than me are sitting here saying, if the Fed indeed is going to drop interest rates by a quarter percentage point, I want to beat the Fed and I'm going to hold more short term. Now, short term could be a year. Anything less than a year is considered short term. And they may play the game of I'm going to buy 3 months, 6 months, 9 months. And so that is kind of what they are doing. The most likely explanation, and I like this expression, drips and drabs. And so the most likely explanation is that banks will start increasing duration. And when they increase duration, it's not like they're going to go buy a whole bunch of 3-year bonds in 1 2 week spree, because for all that it may be something that doesn't happen. Maybe rates stay higher for longer, who knows? And so banks may do it in small pieces. I took a lesson from that. And so here's what I am doing. I am continuing to buy 3 month and 6 month. Here I'm buying 2 month and 3 month. And in a couple of cases, I am still getting out of ETFs that pay a huge dividend and getting into some of these lunch money stocks, as I would call it. These are very small positions, a total of 5% of my portfolio, if that. And the reason I'm doing that is I'm also playing the theory that, hey, what if I'm wrong? What if indeed, the equity market is going to go towards a huge surge when there is a rate cut? And so I'm buying some equities that I believe in. These are all equities that match the Magnificent Seven filter. If you don't know what that filter is, look at some of the previous episodes. I posted a link to one of them here, and they will walk you through value investing. And so I'm looking at some short term, some medium term, some long term, but also increasing duration and drips and drabs, so to speak. So where am I headed next? I'm getting some of the Yield Nerd subscribers into a wonderful wagon, and I'm going where I'm going, and you guys make your own decision. But the bags of money walking on gold coins on Wall Street also looks at some lunch money. And when I say lunch money, as I told you, it's a small portion of my portfolio. I am always intrigued by eggs. Eggs and gasoline to me are things that, gasoline has a lot of attention, but food sometimes does, sometimes does not. And there is a very interesting article, Associated Press, about, hey, what's happening to egg prices? And let's look at what is happening. Egg prices were $3 approximately in February. They used to be 4.21 last year. So we can all cheer and say, look at this magic that happened. Inflation is down. And then somebody tells you, hey, if you go back 2 years, it was a buck 59. So it's almost 100% more than it was 2 years ago. And here we are cheering that inflation is down. Nice. I guess you can believe that. So then the question is there anything seasonal that is happening that is affecting egg prices? Sure. There is the avian flu. When there is an avian flu, then the farm kills a lot of the stock. when they kill the stock, it takes 3 to 6 months to replenish it, and during that time, egg prices go up. Well, here is the challenge. If the farm puts too many chickens, then it drives the prices down. This happened last year when egg prices plunged to $2 a dozen and a lot of the egg farms went out of business. And then there is another really terrible thing that is happening to chicken farms or happened to chicken farms. The 2 years between 2020 and 2022, feed prices doubled. Look at that. If 70% of the cost of raising a chicken is feed and the price of feed doubled, what is that going to do to your profits? And so the combined effect of all of that, and chicken eat wheat, they eat soy, and so the combined effect of all of that is the costs are going up, supply is going down, and you're not able to really make a big profit. And so even though egg prices are $1.59 or $2.99, sorry, the profit really is not that high. At least that is the theory. Well, couple of things I started digging because I do some work in the agricultural industry that inform me otherwise. The cost of feed is actually coming down. Commodities are crashing, 11% since the beginning of this year alone for wheat. Soybean, which is also a component of chicken feed, that is down 20% from a year ago. So the reality to me seems slightly different. The reality is that based on a year ago to now, commodity prices are coming down. The number of chicken that have been culled are already there. The industry is consolidating. Drumroll, I go back to my favorite chicken farm, Cal-Maine Foods. Cal-Maine Foods has been buying up more and more and more of the industry. They actually bought one of the Tyson plants, so they're actually going to process the chicken there as well. So they're expanding their footprint. In the meanwhile, their stock price is 2% lower than where it was last year. And I love the humor in Cal-Maine Foods' earnings announcement. Their stocks soar like a chicken and their stock cracks like an egg. I love it. Having said that, my lunch money thesis is on Cal-Maine Foods. Their earnings come out next Tuesday. I am taking a small serving of eggs from Cal-Maine Foods. That's my lunch money. So my moves are the following. I'm taking my big wagon of money and I'm not going to speculate with the vast majority of it. I do think interest rates are most likely going to go down in June, which means equities may shoot up even more. Having said that, my worries are around election season and some of the turbulence that unfortunately look like that is going to happen. And so aside from speculating with lunch money, I'm going to hold on the sideline for the most part with treasuries, but I am increasing my duration in drips and drabs. Before you do exactly what I do or even consider it, remember, even a blind squirrel finds a nut once in a while. Do your own homework, and thank you for watching Yield Nerd. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.